You're listening to a production of the National Media Archive. To learn more or volunteer, go to nationalmediaarchive.com.
Let me take you back to Boston in 1898, a city of cobblestones, old money, and tradition. Edward C. Johnson II was born into comfort, but not complacency. His father ran a successful dry goods business, yet young Edward wasn't content to simply coast on family privilege. Picture a young man at Milton Academy, then Harvard, surrounded by the East Coast elite, but quietly determined to chart his own course. That's the setup. Now, here's the twist. After World War I service as a radio mana role requiring technical discipline, Johnson returned home with a sharper focus. You might ask, how does a law school grad end up transforming American finance? The answer lies in his early legal work, where he handled trusts and estates, dissecting the mechanics of wealth preservation. This is where concepts like asset management and risk profiling first caught his attention. Now imagine him, poring over stock research in the Roaring Twenties, right as Wall Street boomed and then busted. Instead of fleeing, he got hooked on the possibilities, the conflict between risk and reward. It's this unique blend discipline from the Navy, analytical rigor from law, and a dash of curiosity that set the foundation for Johnson's future as an investment pioneer. Let's fast forward to the 1940s. The Great Depression had left investors wary, markets battered, most clung to bond-safe, familiar. Enter Edward C. Johnson II, who saw value where others saw only risk. Here's the setup. Fidelity Fund, a mutual fund limping along since 1930, battered by years of economic turmoil. Now, the conflict. Should Johnson take a chance on stocks, or play it safe like everyone else? He chose calculated contrarianism, betting on depressed valuations, meaning stocks selling for less than their true worth, and the post-war rebound. But his genius wasn't just in picking stocks, it was in democratizing access. At a time when investing was for the few, not the many, Johnson envisioned research-driven investing for all. Now you might be thinking, wasn't this risky? Absolutely. But Johnson didn't just speculate, he built a research team, hunting for growth stocks and cutting out costly middlemen, aiming to align Fidelity's interests with its clients. The resolution? This client-centric, research-first approach would become the backbone of Fidelity, challenging the old guard's fee-heavy, exclusive model and paving the way for a new financial era. Let me tell you a story. In 1946, Johnson didn't just settle for running a funder-established Fidelity management and research company. Why? Because he saw that due diligence, thorough background checks on investments and portfolio diversification could uncover hidden gems in the market. The setup? Investment research at the time was ad hoc, often biased by brokers' commissions. The conflict? How could ordinary investors trust that recommendations weren't just lining someone else's pockets? Fidelity's answer was radical build, a dedicated research team whose sole job was to find undervalued companies, not just follow trends. Johnson insisted on transparency, making sure clients understood what they were buying and why. Audience, think about it. Would you trust your life savings to a black box, or to someone showing you every step? Fidelity's open book policy built loyalty and trust, values still core today. The result? A new relationship between firm and client-owned based on education, not just transactions. That's how Fidelity started to earn its reputation for reliability. The 1950s and 60s America is booming. Factories hum, suburbs sprawl, and the stock market soars. Fidelity is perfectly positioned, but so are its competitors. What sets it apart? Here's the setup. Millions of new investors, but few understand the mechanics of a mutual fund or the importance of compounding interest. The conflict, skepticism, and confusion slow adoption. Fidelity's solution: demystify investing. They pioneered educational materials, simple explanations, and a customer service ethos that made Wall Street accessible. Imagine calling a phone center in the 1960s instead of mailing forms. Revolutionary. You're probably wondering, wasn't that just good business sense? Yes, but it was rare. Fidelity's early adoption of computerized record-keeping, what we now call data management accounts, were more accurate and scalable. That commitment to clarity and technology propelled Fidelity forward, transforming it into a household name. Let's zoom in on the 1960s, a time when computing power meant room-sized machines, not smartphones. Fidelity bet big on automation and centralized data storage. Setup. As clients multiplied, managing accounts by hand became a nightmare. The conflict? Human error missed transactions, messy ledgers, delayed statements. How could Fidelity keep up? The answer: invest in early computers and launch a dedicated phone center in 1962, the precursor to the modern call center. This leap meant clients, whether in Boston or Boise, could handle investments remotely. Now you might be asking, doesn't every company do this now? Sure, but imagine the courage it took to automate before it was the norm. In an industry built on trust, Fidelity gambled its reputation and won. The resolution? This blend of tech and personal service set new standards for efficiency and client experience, not just at Fidelity, but across the entire industry. Behind every great company is a great team. Edward Johnson knew that even the smartest algorithmal research means nothing without the right people. Enter talent acquisition and workforce diversity. Setup. Finance wasn't, in many cases, still a male-dominated field. The conflict? Limited perspectives, slower innovation. How could Fidelity stay ahead of the curve? Johnson prioritized hiring top minds, regardless of background, and promoted women into key roles particularly rare for the era. This influx of new ideas became a secret weapon. You might be thinking, did this really matter? Absolutely. A diverse team brings better problem-solving and more nuanced thinking, crucial for a sector obsessed with managing market volatility and risk tolerance. The payoff? Fidelity not only weathered market storms, it shaped industry best practices for talent development and inclusion. Let's talk about the 1970s, a decade that tested even the savviest investors. Oil shocks, inflation, and stagnant markets made capital preservation and asset allocation household terms. The setup. Fidelity's growth stock focus left it vulnerable as markets flatlined. The conflict. Should they double down or pivot? Through careful analysis, Fidelity diversified its offerings, introducing money market funds, short-term, low-risk vehicles that offered liquidity when clients needed it most. Now, if you're thinking, was this abandoning their roots? Not at all. Instead, it was a nuanced application of the original philosophy: pursue growth, but hedge against market cycles. Resolution? By embracing diversification and innovation, Fidelity not only survived a turbulent decade, it emerged stronger, proving its model could withstand economic storms. Organizations rise and fall on leadership. In 1972, Edward Johnson III took the reins as president, with his father still guiding the ship as chairman. Setup. Generational handoffs can be fraught with tension. The conflict. Would the new guard preserve Fidelity's core values, or chase short-term fads? The Johnson legacy and emphasis on research, long-term thinking, and nurturing talent remained intact. The family's stewardship ensured continuity, even as the financial world evolved. Now, you might wonder, couldn't this have led to stagnation? In fact, it did the opposite. Their stability attracted top talent and loyal clients, giving Fidelity a unique edge. The result? Decades of sustained growth, with the Johnsons embodying the company's commitment to client relationships and prudent innovation. Today, Fidelity Investments is a global giant. $5 trillion managed, $12 trillion administered, nearly 50 million clients. But size alone doesn't tell the story. Setup. The modern investor wants more than mutual funds. They demand ETF access and retirement products tailored to their needs. The conflict. How to serve both novices and sophisticated traders alike. Fidelity's answer: expanding into 401(k) plans, discount brokerage, and platforms like Active Trader Pro. Fractional share trading, where you can buy a slice of a stock, open doors for younger investors with modest means. Maybe you're asking, is Fidelity just following the crowd? Not quite. Their ongoing investment in fintech and client customization sets them apart, keeping the customer at the center of everything. Resolution. Fidelity's evolution is a case study in balancing tradition with transformation, scaling up, but never losing sight of individual investors. Let's peer into the future. Fidelity isn't just sticking to stocks and bonds, it's exploring digital assets like Bitcoin and leveraging artificial intelligence for smarter investing. Setup. Markets move faster. Clients want instant answers. And new asset classes like crypto are rewriting the rules. The conflict. How can a legacy firm stay relevant in a world of blockchain and robo-advisors? Fidelity's strategy is twofold. Offer institutional-grade crypto custody and use AI to personalize financial planning and optimize portfolios. Blockchain, for example, could revolutionize back-office operations. Think of it as a super-secure, transparent ledger. You might be thinking, is this hype or history in the making? Fidelity's track record says they're betting on evolution, not revolution, carefully integrating new tech without abandoning their core principles. The takeaway? Fidelity's journey from Boston law firm to financial powerhouse proves that resilience, adaptability, and a relentless client focus are the keys to enduring success in any era.